I'd like to welcome everyone to the New York Alternative Investment Roundtable monthly podcast for February 2023, entitled Has the Forecast Changed? I'm Robert Akeson of the Riverside Management Group, the moderator, and we are very pleased today to welcome back, I should say by popular demand, Gary Brode of Deep Knowledge Investing and Mark Rossano of C6 Capital Holdings. I think you're going to find their perspectives and insights to be as interesting as we found them late last year. In a moment, I'm going to ask Gary and Mark to say a few brief words about themselves. Before we do that, though, just a couple of housekeeping items. First of all, I do want to thank our sponsors for their ongoing support of the roundtable and this call in particular. They include, as you can see up on the screen, let's just change that page, Brode, if we can. Alston Bird, Baker Tilly, Bloomberg, Deloitte, Grant Thornton, New Mountain Capital, Ultimus Leverpoint, and our nonprofit sponsors, Kaya, the United Kingdom Department of Trade, Fordham University Gabelli School of Business, and the Grand Duchy of Luxembourg Trade and Investment Office. I just want to remind everyone that Gary and Mark will be going back and forth. And as you see, we're on Zoom, so you can send questions in the lower right-hand corner. So without further ado, I would like to introduce Gary Brode, or reintroduce, I should say, Gary Brode and Mark Rossano. Gary, why don't you take us out and maybe say a few words about yourself before we go into the event?
Thanks, Bob. Much appreciated. And thanks to you and BJ and the New York Alternative Investment Roundtable for having me and Mark back again. Thrilled to be here. I run Deep Knowledge Investing. We are an advisory firm. We work with everyone from billion-dollar hedge funds to RIAs, family offices, and individuals. And we help people get better returns in the equity portion of their portfolios. We've done that successfully. One of the things we've talked about before, we started preparing our investors in November of 21 for inflation, shorted the market ahead of the Fed rate increases in January last year. And in the meantime, whether the market was going down in December or up in January, our individual stock picks have produced a huge amount of alpha. We've been outperforming the market with a fraction of the market risk. So always happy to work with a variety of people and help them get better returns. That's our area of expertise. Thanks.
Sure. So I'll jump in. Thanks again for having us. I echo Gary's sentiment. So just to give you a little bit about me, we started a private equity fund, C6 Infrastructure Partners, and it invests in energy infrastructure. So it's across three verticals, and it focuses across the energy transition. So the three verticals are baseload power with a laser focus on hydroelectric. Another is food and fertilizer shortages. So it's one of the key things that we saw starting back in 2009 was the food shortage and the issue on yield, which really started to crop back up in 2012. And so we're investing in ways to address the food shortage and provide fertilizer that's not only renewable, but also increases yield while decreasing cost. And then on the last front is diesel, investing across the renewable diesel space. We're not a huge fan of biodiesel, so we're trying to hone in more on the renewable diesel side, trying to use waste product to create it. So outside of that, I also do a lot of consulting through C6 and through Primary Vision, where we do a lot. We have several, both corporate as well as national clients on a government level. And then in my spare time, we have a YouTube channel, podcast. On the YouTube channel, we have a macroeconomic geopolitical show. We have an energy EIA show, and then a weekend roundup. And I actually just finished filming the EIA show today, looking at the global energy markets. So there's definitely no shortage of things to talk about on that side as well.
Excellent.
All right, Bob. Do you have any more remarks, or
no? We're all set. We're waiting.
All right, terrific.
Looking forward to it.
Thank you. So the title of this is, Has the Forecast Changed? Right. And so Mark and I were fortunate enough to address the New York Alternative Investment Roundtable a few months ago. I think maybe a month before the Bank of Japan threw in the towel. And so we're really glad that we were on film, time and date stamped, telling all of you this is exactly what's going to happen. These are the problems. And we nailed the timing. And so, you know, the question now is, has the forecast changed? I'm going to give my answer. I know Mark will have his own. My answer is the forecast has not changed at all. All of the problems Japan has still exist now, a few months later, but events have changed. And in my view, there are two things that have changed substantially. One is about a month or so after Mark and I spoke, the Bank of Japan threw in the towel and they raised rates. So they've still kept their short-term rates at 0 or even actually slightly negative, but they were trying to hold the line on their 10-year at right around 0, which is completely insane. And I think it was December, they said, okay, we're going to let the yield on the 10-year move up to 50 basis points, 0.5%. And so that was the first thing. What we saw was the first crack from the Bank of Japan after years, after a decade of 0% rates. They finally said, okay, investors can earn a positive return here. The second thing that I think is particularly interesting that's changed is one of the things Mark and I said when we spoke to you a few months ago is that this will work until it doesn't. And the event that will change things is the bond market will take control. And that's what we saw, right? It's if any of you have heard the expression, you know, the bond market vigilantes, that's a fancy way of saying that the Federal Reserve, the Bank of England, the European Central Bank, or the Bank of Japan, they can set rates. They can tell you we'll defend a certain rate. And that works until the bond market, which has even more funds than anybody else, decides, no, we won't buy at this rate. And they will sell and sell and sell until rates go up. And we saw that. And even though the Bank of Japan was defending 50 basis points, the yield on the 10-year actually went above. And it's the first time in recent memory, at least that I can think of, that the bond market has actually stared down a central bank and said, no, we're not accepting your view of the world. We're going to impose our own view. Now, the Bank of Japan did get that under control. They spent some of their foreign exchange reserves and managed to hold the line, and they've gotten that yield back below 50 basis points. But it's very clear that they're losing control of the situation. That's my view on it. Mark, what do you think? Has the situation changed? Do you see it differently?
No, I think when you look at the extraordinary purchases that because there's typically planned purchases and then there's an extraordinary event, and we've seen them come in multiple times. And there was actually 4 specific days where they were the only buyers, where there was no one else out there. Everybody else was a net seller. And you saw it again, breaching that ceiling, as Gary alluded to. When you break that ceiling, they come in and they buy everything that was there to bring it back down. And you've seen this continuation and this problem continue to play out. And it's interesting because when you start looking at the vigilantes and you start looking at the different shifts, the bond market is, when you look at even in the US, you know, we talked about the inversion of the yield curve and how things were just starting and only going to get worse. And it's continued to play out. You know, now we're looking at something that resembles the 1980s, you know, the early 1980s. You look at the market starting to finally recognize what we had talked about, where the Fed's not going to pivot. You know, they can't pivot. They don't have the ability to do so. And that played out the same way. And now with retail sales coming in where they were, with inflation reaccelerating, you know, that's also something that we had talked about, is that not, and as Gary talked about in Japan, inflation accelerating. Well, it accelerated in the US again. And one of the key pieces, which is important, and we made this distinction as well, is the difference between core inflation, flexible inflation, sticky inflation. And one of the key pieces is that core and sticky side continues to stay. It's not going anywhere. And it's, if anything, it's actually getting worse. And that's something that the BOJ is faced with, where how do they continue to buy and issue more yen when inflation is accelerating? Real yield is under pressure. Real wages are under pressure. But also, who's one of the largest buyers of Japanese products? We are. So when you look at that inflation, we're in this point where we're importing the inflation again. And then you look at China's inflation picked back up. And I think, to kind of end this, because in terms of that kind of rounding where things are, you have to look at food. And you look at India. India's had a massive surge in inflation, well above expectations. And a lot of that was driven by food. You had several programs that were initiated during COVID that are now expiring. And when you look at all of these on a fiscal side, on the government side, a lot of these extraordinary events that took place that whittled down their reserves, whittled down, as Gary talked about, FX reserves, some of these different pieces. And as FX reserves go down, well, inflation starts to go up. Rates have to go up. You have to try to stay in front of this. And I think this food conundrum continues to perplex people, but it's not going away. There's a lot of pressure in this point. And that's why we think that there's going to be a continuous problem on the food front, which is going to put pressure on India. It's going to put pressure on China, and then as well as in the US.
Yeah, I think that's a great point. I was in a discussion on Twitter with somebody yesterday, and I was writing out some of the notes on Japan, some of the things we're talking about here. And somebody was saying, well, Japan has had the easiest money in the world for decades now. Why aren't they seeing more inflation? And for a long time, they didn't. And Japan has had a very difficult time increasing economic growth. Now, part of that is because of the way that they've structured their labor model. And the entire country is aging. Young people are not getting married. They're not having kids. And an alarming number of them are dropping out, right? They're not dating. They're not marrying. They're not having kids. They're doing the bare minimum amount of work to stay home and play video games. And so it's very hard to stimulate economic growth in an environment like that. And so, but this person was saying to me, well, they've had difficulty getting some inflation. And if they've had the easiest money in the world, why aren't they getting more inflation? And I think the thing that people may be missing, there are really two things. One is Japan has insanely high prices. Real estate there makes New York look cheap. And I remember seeing a story, this is from a long time ago, but just to go for a McDonald's meal there could run you $50 a person, $50, $60 a person. And that's kind of a crazy thing when you think about it. But look at what happened last year. The yen went from 100 to the dollar to 150 to the dollar. It fell 50%. Now it's, where is it? We're 133, 134?
134.
Yeah, something like that. Okay. So it's gotten a little better, but you're still down 1/3 versus where they were at the start of last year. And this is very important. Japan is a giant economy, the world's 4th largest economy, but physically it's a small island nation with very little in the way of natural resources. And so all of the fuel that they're importing, everything that they import to make steel, Mark was talking about food. This is a crucial point. All of those things went up between 30 and 50% just in their own currency. And then to make things even worse, we take a look. The dollar last year officially lost about 8%. Our estimate is it's more like 16, 17%. Inflation last year in the US was hugely understated. And so the purchasing power of the dollar in the last 2 years has lost about 20% of its value. And the purchasing power of the yen against the dollar, depending on when you're looking at it, has lost 30 to 50%. So when you're an island nation and you're importing in a currency that's losing value against a currency that's losing purchasing power, it's a huge, huge problem. And I think for the people who are saying Japan's having trouble creating inflation, I'm not sure they're looking at it the right way. Mark, I know you might have a different view on it than I do. What are you seeing on that?
So, and sometimes it's funny because as you talk about, the different inflationary metrics, one of the things that I always come back to is the velocity of money, because I think a lot of times people get lost in that velocity side. And if you consider just, how they're creating it, well, the denominator is the amount of currency in circulation. And if you're putting so much money, you're just dumping it in, the denominator is getting massive, and you don't have the ability to actually move this volume through the market. Instead, instead of creating velocity, creating debt, creating this natural movement, you're just watching it slosh around. And to what you're saying, Gary, in terms of, the cost of doing business continues to go up. They're importing everything from LNG to propane and everything on down, and they're using this money to push out into the market, but they're also looking to try to supplement some of that loss of productivity. We've talked about it, and I've had some back and forth with people who think that a declining birth rate is actually a good thing. And it's like, well, it's not, and it's not for many reasons, but some of the big ones you hit the nail on the head in terms of cost of manufacturing, cost of production. And you look at these different costs going up, and that again kind of eats into it. So yes, you're not seeing this hyperinflation, but you're also not seeing any growth, and they're canceling each other out, creating this stagnation because you have to keep paying people more. And as you pay people more, your cost goes up. So like a $50 meal in McDonald's, but your wages went up. So, but real wages just stay flat. And now one of the things that we've seen is this big tip, because they're reaching the breaking point where real wages are now severely negative. They're no longer able to keep up with this, facade of, zero growth, no inflation. Now inflation is coming through in spades. And this gets to the point of, is inflation rising in prices, monetary policy, mixture of both? And that's where we can get into the fun, economic theory side. But realistically, this is a problem that is catching up. And as you said, like, yeah, the yen has gotten better, but the yen has gotten better because they raise rates. And that's where you have this back and forth. And one of the things that we outlined when we spoke at the previous roundtable is they need to kick the can as far as they can, and raising rates will protect the yen for now, and raising rates again. But at some point, there's going to be that breach and that break. And I think they're getting closer and closer to that point of no return.
Yeah, I agree with that. And for the people who are listening to this who aren't buried in economics and the markets and macroeconomics all the time, it may be helpful to explain an old term. If any of you have ever heard the term pushing on a string, that's actually what Mark is referring to here. And so imagine you have a 10-foot just piece of string, just regular white string, and you lay it out on the floor and you push at one end. Well, the other end doesn't move. You get no effect from it. And that's what Mark is talking about. Japan is at the point where the Bank of Japan can keep flooding the system with money, but it's not really having an effect. It's, as he said, it's just sloshing around. And so they've basically pushed fiscal and monetary policy to the point where there's nothing else they can do. And whatever the basic policy prescriptions they would have are no longer effective. Now, earlier in this discussion, Mark talked about for 4 days, the Bank of Japan was the only buyer. Let's talk about the implications of that. Their capital markets are so skewed by government action that over the summer, there was 1 week, 4 days in the week, where the only buyer of Japanese debt was the Bank of Japan. So now try to imagine that in the US, right? The Treasury has auctions every week. And what if, and those bonds are traded. What if for an entire week, the only buyer, the only participant in that market was the Federal Reserve? What that's telling you is that the market has said, you know what, we're out. We want nothing to do with this. And when that happens, there's nothing the Bank of Japan can do that will actually have an impact on the market. The market has decided we don't want to participate in this. And so they've pulled their money to the side. And one of the reasons why Japan has such a currency problem is, think about it. Imagine for a minute that you're Japanese and you're sitting there in Japan. And so you have savings. The natural thing, if you have savings and you don't want to take the risk in the stock market, people typically buy bonds. Well, if the Japanese denominated, the yen denominated bonds are yielding 0%, you wouldn't do that. You might want to buy US Treasuries, and the yield on the 10-year, Mark, what is it now? Like about 4% right now? It's higher. It's actually above, now it's about 4%.
Yeah.
Right?
It's about 4.
Yeah, it's about 4. Okay. So what you would do if you were in Japan is you would sell yen, buy the dollar, and use those dollars to buy US Treasury securities, and you would go from a 0% yield to a 4% yield, and that's a big deal. But as that happens, you selling the yen and buying the dollar, that's one of the reasons why the yen is falling and the dollar is increasing. And so it's a long way of saying that the Japanese government and the Bank of Japan, they've pushed their policies so far that they've gotten to the point where nothing they do anymore is going to matter.
And you bring up a great point with looking at it in terms of, what happens if this happens to the Fed and where it is. And we always come down to who's the buyer of last resort. And at what point does the buyer of last resort exhaust itself? And when you look at the US was bailed out by Chinese infrastructure spending, Chinese stimulus in 2008, again in 2012, again in 2016. And then they started to peter out in 2019, and things were really starting to turn. Obviously, COVID created this social experiment of epic proportions. And now we're coming to the point where, even in the U.S., who was the buyer of last resort? The Fed is now a net seller in theory. They still haven't sold to the same degree, and you still have so much liquidity just sloshing around, and the Japanese market is just magnitudes above even where we are. Not so much, just on a percentage basis, just to kind of normalize things. When you look at that debt to GDP level, when you look at the fact that they not only been buying debt, they've been buying the Nikkei, they've been active in so many different markets trying to prop things up. So when you look at this stagnation, what would it be like if they weren't there? And now they're sitting on something where do they just take the whole Nikkei public, or really under the BOJ? And at what point do you start to reduce your balance sheet? Because to Gary's point, I'm pushing on the string. There's the law of diminishing returns. It takes a bigger and bigger amount to have the same impact or try to outdo the previous impact. But then there's a point where no matter what you do, it's a negative effect, or in economics, a negative util, where there's no utility to it. There's nothing you can do next. And that's where we're getting to that point. And now beyond that point in a lot of regions. And when you look at China, which is falling under a similar trap, that's like a mixture of Japan, Russia, the USSR and the US, you look at the leverage ratios and how exposed different people are to different components. Like when you look at the Japanese buyer exposed to their local markets, trying to live within this realm. But then you look at China, the average person has a 68% connection to the real estate market. The real estate market's imploded. So everyone keeps pointing to China saying, oh, China has a ton of savings, they're going to dump it into the market. It's like, if you were to take the losses generated from the real estate market and the savings that have been built, the average Chinese individual is still underwater by 20%. And you have to think about this as a savings entity. When you consider the Asian mindset, it's more about savings and less about spending. So you're just never going to get that local demand, which is a problem when you start talking about Japan and then onwards. And you might be thinking, why are we spending so much time talking about Japan? Well, when you look at the fact that it's the third largest economy in the world, a significant amount of every product we touch either resided in Japan as a semi-finished good, a finished good. Some sort of it is impacted by the Chinese market. And then the connection side, where you get this contagion, as we saw in the 1998 Asian currency crisis, and as it is really looking to set up once again, but we don't have the backdrop of, well, the Fed can step in, central banks can step in, the government can step in. Well, all of those bullets, a large part of them to this point, and still counting, were utilized in 2020, in 2021, and continued to be utilized really until the early, 2022, until everyone was like, oh, we should probably start tightening because there might be a bigger problem coming down the road. And it's like, yeah, guys, like, you created the problem. And then the last point before I, to get off my soapbox, you have the UN sitting there saying this, this rate rising is the worst policy decision ever created. This is why we're in this mess. It's like, no, the last 10 years is why we're in this mess. And then the inaction in 2021 as assets ballooned to record proportions as wages rose, but by no means kept pace. That was the policy decision. That was the error. That was where we made the problem. And now we're sitting in this this fun world that we have to try to untangle.
Yeah, I know in this overregulated world, everybody is careful about issuing anything deemed financial advice. I'm actually going to give financial advice here. Nobody should ever take financial advice from the United Nations. I'll stand behind that. It's not an organization that understands how finance works or should be allowed anywhere near money. It's just not what they do. So that's my financial advice. I'm on record, do what you will with that. I also think, Mark, you brought up a hilarious question, which is who has the bigger mark-to-market problem right now? Chinese citizens who, as you said, have almost 70% exposure to real estate, or United States private equity. And that could be a really interesting competition, right?
Absolutely.
Whose mark-to-market would be more catastrophic if they represented actual market conditions. I think it's important to explain something that you were just saying. I was taking notes while you were talking, and you made this great comment. And it's if anybody is going to take clips from this, here's your clip. It was a minute ago. It was Mark saying, no matter what you do, once you reach a certain point, no matter what you do, it has a negative effect. And it's a brilliant point and extremely well stated. It also deserves a little explanation here. And so the reason Mark is saying that, and I agree with him completely, is because let's look at the situation Japan is. And once you understand it, you can see why the two of us are so negative on that. So Japan, because they've kept interest rates at zero for more than a decade, has been able to run up massive amounts of debt. I mean, we've all talked about the huge debt the United States has. Everybody says, oh my God, $31 trillion. But in Japan, the debt to GDP is 260%. And that's generally not a problem when your interest rates are zero, right? And it's really not a problem if your interest rates are negative. If you can issue 260% of your GDP and collect money on that, especially in a declining currency, you actually can do pretty well, right? I mean, that would make sense. But here's where they are right now. Where they are right now is their policies have created massive inflation. And again, we see that in the currency. When your currency is 30 to 50% depreciated against a currency that's down 20%, your cost of living goes up. And Mark talked about negative real wages. That's when people get an increase in their salary, an increase in their wages, but it buys them less. And so Japan has this huge inflation problem right now, which we're seeing expressed as a currency devaluation effectively. And so the policy prescription for that, the thing that fixes it, is Japan needs to do what we're doing here in the United States, which is raise interest rates. Okay, sounds perfectly fine. But the problem is when your debt to GDP is 260%, and you raise interest rates, you blow out your budget deficit. You can't afford it, right? And this is the thing that we're also coming to terms with in the United States. Past a certain point, our interest expense plus our non-discretionary payments is greater than our tax collections. And that's the situation Japan is going to be in, only they're going to be in that at an interest rate that won't stop their inflation problem and their currency debasement problem. And so if you're Japan, what do? The only way around it is you have to print more yen. Well, that causes more inflation. So Japan is basically in a situation where the things that they would do to fix their inflation problem will actually create inflation. The only way out of it is to print more yen. It creates more inflation. And so I'm going to go back to Mark's great quotation, which is no matter what you do, it has a negative effect. He's 100% right. And that's the reason why.
And when you look at the shifts that are happening, and I think they're problematic, and why you have this relationship going back across the Asian region, is then you start turning to China and you start looking at the options they have, where, depending on whichever metric you use, 360% debt to GDP, and they're issuing more special purpose bonds. And the problem with issuing more bonds and trying to drum up more infrastructure spending. So you look at Japan, which has beautiful cities, massively built out, a lot of that on the cheap debt side. Well, okay, well, where are you going to invest next? What's the next level of investment? And at what point, if okay, well, this project is left. We ignored this project for the last 10 years because it'll never make money. It'll only, it'll have what's a negative impact, where if you think about the different turns and turns on debt. So typically for every dollar invested, you want to make money on that dollar. So if you look at the US, when we went through the massive build out of the highway system, for every dollar invested, it yielded north of almost $5 of GDP growth. So every dollar you made $5. When you start getting to these debt to GDP levels, that means that you're borrowing, in Japan's perspective, over 250 for every dollar of debt of economic growth you're generating. And so when you start throwing more and more money at it, well, what are you actually achieving? You have to bring one down to bring the other up, or you have to try to bring the economic growth side up with a decline in population, with a decline in production. I'm sure everybody has heard the term nearshoring, onshoring, diversification of supply chains. Well, are you really going to attract new people? Are you going to attract or are you going to be the person that's going to lose manufacturing because it's going to go to Africa, it's going to go to Mexico, it's going to come back into the US? And some of these flows continue, and then China is seeing that on a same scale, if not massively bigger, when you look at, Apple's talking about leaving, diversifying their flows. And now you're sitting there with, you want to issue more special purpose bonds, but the rate of return you were getting previously on special purpose bonds that were issued after 2018 was about 0.87. So that means that you weren't even covering principal, let alone the interest. And you're going to issue more to invest in what? And that's where you start getting this cycle. And that's when the spiral starts. And as we saw in the USSR, as we've seen in other controlled economies, and especially things that had a huge influence from both the government and the central banks, you create a spiral you can't get yourself out of unless you just default. And then who takes the default? And you look at China, people will say, well, a lot of that debt's internal. It isn't. And they have turned to the international markets. They have turned to the international world and invested in a lot of these third world countries on the Belt and Road Initiative, on the Made in China 2025. And Japan's something similar. You still have a huge exposure because most of your products are bought by other people. So if your inflation is going up, how do you try to get more competitive on the export market? Do you devalue yourself further so then you can then compete more aggressively against China and South Korea? But then what does that devolve into? What does that create? And you keep getting yourself into these spirals where the moment you fix one eddy, a gigantic tornado has just been created on shore, and you're trying to put out all these fires until you're overwhelmed and you have to reset the system.
Yeah, it actually, Mark, what you're describing sounds a lot like what goes on in my home state of Connecticut, which continually loses money on infrastructure spending. And so the answer they think is, oh, we need to do more of that. I'd just be satisfied if they did anything well, which would be nice, right? And so that would be great. Yeah. So let's shift the conversation for a second. Last week, I think it was, we got the announcement of the new governor of the Bank of Japan. And the reason that I thought it was particularly interesting was a lot of the discussion was, okay, well, the good news is that the new governor is more hawkish than the guy who's exiting. And so, maybe we'll get better policy. But when you look at his comments, he's basically giving what would be a very traditionally Japanese response, which is, yeah, we're not really going to change so much. We're not going to do anything quickly. And on the positive side, good for them for being contemplative. The problem is that they're in emergency mode right now, whether they recognize it or not. And, I think part of it does also come to Japanese culture, which is, in the United States, we'll have somebody take over a position And on day one, that person might say, okay, look, my predecessor, good person, but terrible at his job. We're changing everything, right? We're going to throw out everything the last administration did, or the last CEO did, or the last minister, or whoever it was, and we're going to do everything completely differently. And then
kitchen sink it. Just
Right,
everything
right.
was their fault. Kitchen sink it.
It's on them. That's not a traditionally Japanese response to things. They're much more likely to say, well, we respect everything that was done before, and we don't want to change too much. And it's just not in their nature to say the guy before me screwed it up, and so I'm going to do everything differently. And so I suspect that there's not a lot that's going to change. Of greater concern is the fact that if I were in that position, I don't know that there are a lot of good policy options, right? Even if the new governor of the Bank of Japan wanted to do something differently, I don't know that he has a lot of options. And so, Mark, I'm going to go to you with two questions. Question one is, what do you think of the new appointee? Do you have a view on this individual? And two, I'm going to ask you the same question I did when we got to speak to New York Alts a few months ago, which is, if I could wave a magic wand and make you governor of the Bank of Japan, what would you do?
So I think that it is a good appointment just because he is more hawkish. There is a bit willingness to admit that the dovish stance might have been a bit too aggressive for too long. But then the question is, how are they willing to make those tough decisions? And realistically, the biggest component that they need to do is try to buy time to get to the point where the economy starts to recover, global trade starts to pick up, because right now they're in this position where they have to try to grow their way out. I mean, that's really what you alluded to with trying to just, churn. They need to grow their way, because if you look at the debt to GDP ratio, so you either bring down your debt or bring up your GDP. And how do you do that in an area where you've been in stagflation, you have the lack of local demand, you have those pressure points. And so realistically, they've relied significantly on foreign direct investment and the export market. And I think at this point, the way that you can try to do that is create running room, and creating as much running room as you can by cutting the deficit, bringing in austerity to a much larger scale, but then at the same time, trying to drum up additional export capacity to try to grow that side of the business. The problem is, and I have a great chart on it, global exports, the global trade really kind of peaked in that 2016 point. And we really just went sideways, and there was a lot of noise in between. And if anything, it's actually started to tilt downwards a bit, where global trade has been on a downward trajectory. There's always peaks and valleys in that, but it's not moving in the right direction for a country that has so far relied so significant on the local export, on the ability to export market, because you can't rely on the local market. And that's the only thing that I think they can try to do, which, and as you talked about, by raising rates in order to achieve what I'm talking about, you're going to increase your internal cost, because you're going to have to roll your debt. You're still issuing new debt. So how do you balance that approach? As you take a mark to market, you could say, look, I'm going to retire some of this debt. I'm just going to pay it off outright and try to create this balancing act. But again, who owns the debt? How do I buy it back and then retire it? Because someone is being paid off of it. It has to go somewhere. And some of the MMT views, it's like, oh, you just put it in the fire and it burns. It's like, that's not how that works. There's connections to that. And that's the only thing that I think you can do. And unfortunately, I think it'll still lead to a rolling default. The problem, the question is going to be by how much, and what does the shakeout look like? Because as Gary sits in Argentina right now, who has seen 3-4 rolling defaults in the last 30 years.
Oh God.
I think by the time I left Morgan Stanley, they were still fighting ISDA, because they owned CDSs on I think it was the 98 default, or it could have been the 2001. And again, so there has been precedent for it, never obviously on the scale and the size of the economy, But I think that that would provide a bit more of an opportunity, because as the running joke goes, the day the question posed to me by an old boss was, when do you think somebody would be willing to lend to you if you defaulted? And I was like, I don't know, you have to build up your credit score. And he's like, the day you default is the day somebody will lend to you. And you've seen it in Argentina, you've seen it in Brazil, you've seen it everywhere else. And the idea is that the same would happen in Japan.
Yeah, and by the way, Argentina has defaulted even when they've promised not to. There was a very famous case, I think a decade or so ago, where Paul Singer and Elliott Management owned Argentinian bonds, and one of the clauses in the bond was that they couldn't default, that no matter what, they would make those payments ahead of everything else. They were senior bonds. And the Argentinian government defaulted anyway. And Singer had an Argentinian naval ship that I think was in Africa at the time impounded. To Paul Singer's credit, all accounts were that the sailors were treated very well. They were put up in hotels and fed and housed and treated well. But when you get a naval vessel impounded in a foreign country, it's generally a sign that things aren't going well. One of the things I just want to say for the people who are listening to this live, if you have questions, just use the chat function. I'm watching it right now. And so feel free to ping questions in. For those of you who are watching this, on YouTube or on the New York Alt website or a recorded version, that won't work. You won't be able to submit questions live. It's too late for that.
But Gary, what we will do at the end is we'll show your contact information again. And we certainly encourage everyone that's either live or sees this at some point in the future to reach out to you, gentlemen.
Thanks, Bob. Really appreciate that. Thank you. Mark talked about a rolling default. And one of the key points here, and people have said, well, will Japan default? And the answer is not really, sort of. And let's be clear on that. Japan's debt is denominated in yen. They'll pay it because they can print yen. The question is, once you print enough yen to pay off debt that's 260% of your GDP, what does that do to your economy? And the answer is it crushes it. And so, people say they can't default, and there are actually in this situation, paying their debts might be worse than defaulting. They actually might be better off defaulting, defending the yen, and then, as Mark said, just saying the day after they default, okay, new debt, new yen, lend to us now. That actually might be a better answer than paying their debts. The other thing that I saw on Twitter, which I thought was really interesting, I said I was having a bit of a discussion online about this, and one person who took issue with my point of view on this, and it's fine, everybody's entitled to their point of view, said, hey, but Japan's running a trade surplus, that's a plus, right? And the answer is, in general, yes. In general, it's good to be producing more than you're consuming. In general, it's good to have people owe you money, particularly at times of great financial stress. And that actually makes a lot of sense. But it's worth pointing out, one of the reasons why Japan is running a trade surplus is because the value of the yen has plummeted so badly. And so what they're exporting, they're getting a lot of yen for it, but not necessarily so many dollars or euros or other currency for it. And then what they're importing becomes incredibly expensive. And as what they're importing becomes incredibly expensive, it means you're going to import less of it. And so while in general a trade surplus is a good thing, in the case of Japan in these specific circumstances, it's not a sign of economic health.
And some of the other key pieces to it as well, when you start looking at the devalue front and the cost of goods, and this is where you start looking at the issues abroad. When we start looking at base metals, we start looking at crude, LNG, other pieces to the puzzle. We've underinvested on the supply side on a lot of different metals, on a lot of different quality commodities. And now when you start looking at the financing piece, back to the point of what Gary was talking about, of trying to maintain some of this, and what I was talking about with trying to maintain some of the surplus, is, well, what does your cost look like? What is coming in? And typically in a recession, goods get cheaper because the cost to there's surpluses of aluminum, of iron ore, of steel, of crude. All of these things are in surplus. So then inherently your costs come down. People buy more because your currency is going to go further. Instead, this is a bit more like the 70s when you start looking at these shifts in commodity prices. Like if you look at Chile, for an example, the one of, if not the largest producer of copper, they've gone green. And what is copper production? Not overly green. So all of a sudden you have a demand which is fairly flat, if not increasing, based on government subsidies into renewables and other types of formats. But you also have a supply problem where Chile is producing copper at below 2013 levels. So when you look at flows in general, all of a sudden it's like, well, and if we go back to just the basics of economics of supply demand, well, if supply is coming down, in order to get a price response, how far does demand have to go? And is there a certain amount of demand inelasticity where it physically can't go below that? Then you start to get these price increases that are just become so painful that you have to cut production further than you'd like. And you start to see it actually hit economic growth. And I think Europe is a perfect example. Ahead of everything that we saw with Russia, they tried to store up as much natural gas as they possibly could. And what did that do? Well, that created they had to shut down 40% of petrochemical production. They had to shut down 70% of fertilizer production. They had to shut down 30% of refining production, all because they had to reduce electricity consumption, reduce consumption of product. And yes, they succeeded in storing more natural gas. Right now they've been trying to buy as much Russian diesel ahead of the sanctions that they implemented against as of February 5th on Russian refined product. But at what cost? So yes, things look okay right now, but now you want to get your economy back in action. Well, how quickly are you going to draw down your natural gas storage because you're not refilling it the same way you did in January? How are you going to replace all of this diesel that you're now consuming to run your supply chain, because you can't readily go buy discounted Russian product that they're dumping into the market. So all of a sudden, as you start to balance out, you get these unnatural shortfalls. That is more like the 70s when you had the embargoes, you had the shortages, you had the underinvestment. And that's why we're not going to see this massive, deep recession of, oh my God, the US economy is down 25%. It's going to be this painful, slow bleed that is just not going to see some of this, where at times it's easier just to rip the Band-Aid off. But instead, we're going to get this bumping along the bottom, where you can call it a soft landing, I guess. But if you're having a soft landing multiple times, at what point do you just vibrate yourself to death?
Mark and Gary, given your very insightful comments on both Japan and China, we have a question from the audience here, which runs along the following lines. What are the implications for the US dollar and the US economy, certainly in view of what's going on with the debt ceiling? Any thoughts on that?
Yeah, I do. The debt ceiling tends to get a lot of attention. Everybody panics. There's this sense that, oh my God, if we don't fix this, the whole government's going to have to shut down. And that is factually incorrect. First of all, these things always get resolved. And the reason they get resolved is because both parties in Washington are addicted to insane levels of spending. There's this fiction out there that, it's the Democrats who are insane spenders and the Republicans who are sane on this stuff. This is completely false. President Bush was a huge spender. President Obama buried him in spending. President Trump took the Obama budgets as a baseline and spent more. And then the current administration is busy adding trillions of dollars to that.
Gary, we've had 5 balanced budgets since 1960.
Yeah, exactly right. And we've seen this with Democratic presidents that had Democratic Congresses and Republican Congresses. We've seen it with Republican presidents that had, friendly
Reagan himself
Congresses
was a prolific spender.
Yeah, exactly. So everybody in the end, compromise used to mean, okay, I'll get some of what I want, you get some of what you want, we'll cut a little of the things I like. It doesn't mean that. Compromise now means I get all of my spending that I want, you get all of your spending that you want. And so these things always get resolved. But here's the key thing, and this is the thing that I think a lot of people don't understand. If you look at the US Constitution, and I know, right, this antiquated document that nobody pays any attention to anymore, it actually says something along the lines of the debt of the United States cannot be questioned. And forgive me if I've gotten the exact language wrong, but I have the gist of it right. And what that means is that the United States government cannot default. And what that means is if they need to, they will cut all other spending and pay the interest on the debt. Well, the United States will not default on its debt. It can't. And if along the lines, this means that we need to have a little fiscal austerity and show that the country can manage without spending, $5 trillion a year on balance sheet, $10 to $12 trillion a year off balance sheet, it'll be fine. It really will. The default, the US is going to default because of the debt ceiling stuff. It's salacious headlines by a press that loves salacious headlines. This is not, there's nothing that's going to happen. The United States will pay the interest on its debt.
And just to follow on that, because I agree, they use it as a bargaining chip to just spend money in other places. And I think it's important to look at, to Gary's point on what happens next and what can be learned and whatnot. So when you look at Medicare and Medicaid, just on average, total government spending for the 2023 budget is 1.6 trillion. Social Security is 1.3 trillion. And I know that everyone loves to talk about defense, which is 795 billion. But when you look at the pieces of the puzzle, I mean, that's where the problem, and this is, and again, anyone who quotes Keynesian economics, if we were to wake up Keynesian today and show him what is being called Keynesian economics, he's like, I didn't write that. That was not what I created. I don't know what you guys are quoting, but that is not me. But the problem is human emotion, human attachment. You give someone $1 and then 6 years later you tell them they're taking the $1 away. It's like, whoa, what do you mean you're taking it away? I need that $1. And that is the difficulty that we're in. And the longer this gets prolonged, like right now, our estimated borrowing is supposed to be 17% of the current budget, which is almost $1 trillion, just under. And to Gary's point, it's like at some point, the net interest, which is currently 8% of our 2023 federal budget, isn't 8%. It's 10%. Then it's 12%. And I think at that point, it's almost going to be to a level that can't be ignored. And once it hits that level, that's when I think the bigger austerity, but then forced austerity, as we saw in Greece, as we saw in Europe, in general, tends to be a problem as well. What do we have to do? We have to make hard decisions. We have to really scrap Medicare, Medicaid, try something different. We have to adjust Social Security in terms of what is the retirement age. And I know that as someone who's 38, I would love that to happen just because that would adjust for some of the places that my money's coming in. But you have to look at balancing and this is where population comes through. How many people are paying an income? Like Bobby, you talked about, we balanced the budget. It wasn't because we were good at spending. It's because we created a new industry. Or you had .com money flying around. You had capital expense coming in, capital interest. You had realized income that was massive. And we need to get back to focusing on R&D. And
Mark, it gets back to something you said a moment ago about Keynes. Keynes is often misunderstood. Keynes warned against debauching the currency.
Yep.
And it's forgotten. And in fact, if you go back to the 30s, you'll see that there was really two depressions. There was the big depression and a smaller depression. And the smaller depression, I think, was around 1937. And one of the reasons we had that contraction in economic activity had to do with the fact that FDR, who himself was a Keynesian, right, wanted to balance the budget.
Yep.
And by the way, guys, there's one thing that I would add to this, and to the extent that I've sort of acted like this whole budget issue is a sideshow, I want to be clear. It is a sideshow, right? That's not an accident. I'm not being glib. People are very focused on the $31 trillion we owe. That's an obscene number, but a lot of people aren't looking at the off-balance sheet number. And when we start to look at things like Medicare, Medicaid, Social Security, pension funds, the actual liabilities in the United States are not $31 trillion. It's somewhere in the neighborhood of $250 trillion. That's $250 billion.
Right.
That can't be paid. It won't be paid. To the extent that people are getting worked up over how we're going to pay the interest on the 31 trillion, that's not the issue. The issue is we need to do something about the $250 billion, because that's the thing that's completely unmanageable. 31 trillion we can manage. The rest
Gary,
of it,
can I push back on this for a second with you?
please. Yeah.
You said a moment ago that it's a sideshow, and I hear what you're saying about that. But isn't the position of the United States really quite unique among the nations, in the sense that the United States is also the home of the world's reserve currency? So these shenanigans can take place in other countries, and you've mentioned some of the names before. But the United States has a special position, and one would argue an exorbitant privilege has been conferred on this nation by virtue of the fact that we hold the reserve currency. So if the reserve currency is sponsored by a nation that can't fulfill its obligations, do you see that having any impact on, let's say, investors and consumers' willingness to hold dollars as a store of value and a medium of exchange?
Yeah, so first of all, regarding the willingness of investors to hold dollars, that's not happening. That's not an issue right now, because nobody's focused on the $250 trillion.
Because we haven't defaulted. And no one thinks, like you said, no one thinks we're going to default.
Right. Well, we won't, not on the 31 trillion, but the issue is we're going to have to restructure
the whatever the number is, like,
right. Right.
That's a more serious issue.
Yeah. So I would also make another point. When you're saying the United States is unique in the world and that we have this position, I agree with you, but I would amend your statement with two words, which is we are in a unique position in the world right now. And you need to take, or I would suggest rather, taking a longer term view. And if we look back over the last couple of thousands of years, what we've seen is that whoever held world hegemony, whoever held that version of the world's strong currency, whether it was Rome, Spain, Great Britain, now the United States, that only lasts a few hundred years at best. And that's not a permanent position, and we're already starting to see cracks in the dollar. The biggest issue, we just saw the Saudis agree with China. They're going to start pricing oil in yuan or renminbi.
Yes.
These negotiations are taking place.
They're going to do what Saddam Hussein threatened to do in the 1990s, which was to remove the linkage between dollar and hydrocarbons.
Right. And the difference is we had a relationship with Saudi Arabia at the time that enabled us to continue with the existing system. But the Saudi royal family despises the current White House, and they've just decided they're going to switch horses. And they've abandoned the petrodollar agreement that was made between Kissinger and the Saudis back in the early 1970s. And we're seeing that happen right now. Now, is that going to crash the dollar tomorrow? No, of course not. But you have
doesn't this have something to do with the fact that China now is the largest consumer of oil?
It certainly is an issue. That absolutely is. The point that I'm making is we have the world's reserve currency. We have this unique status right now. That's not a permanent position.
Exactly.
I wish it were, but wishing won't make it so.
So just to look at that for a moment. So one of the things is and to Gary's point,
And Mark, I'm sorry, I just want to remind everyone or point out that we're nearing our closing time here. So I'd like to ask both of you for closing statements, brief closing statements, and we'd love to have you back. Go ahead, Mark.
One of the things is when you look at it, and to Gary's point, and to hone it in a bit more, it's who controls the trade lanes and who controls the trade lines, and that's the military that maintains the currency. And the one thing that when you look at China has grown in the sense of what they've consumed in terms of crude. But unfortunately, and if you look at actual current policy, they're trying to address this. Made in China is not exactly screaming quality to you or anyone, even within China. And it's not surprising that their industrial accidents are growing in sheer size because of the different things that were cut, different ways or redundancies that were ignored. And so the Saudis talk a good game, and FDR made a lot of commitments back during World War II, and then Truman was like, that was the other guy. This is me. We're not going to honor that. And that was a slight on honor, which then resulted in what was Chevron becoming Saudi Aramco. But they still need us for a lot of safety and important reasons, which are both public and non-public. So I think that the game that they play on the petrodollar is just that, a game. Just as the getting rid of the debt ceiling is a game, that is a game that they play it, and they play it as much as they can. But at the end of the day, every meaningful engineer in that country comes from one nation. Every meaningful missile that is in that country comes from one nation. Every meaningful naval vessel that guards the Saudi crude comes from one nation. And as long as all three of those things are the case, it's going to be very difficult to do it. They want to pander to China, and there's a lot of reasons to do so. They need money, but they're getting money coming one direction. Yes. China thinks they're getting joint ventures, and we all know what a joint venture means to Saudi Arabia. Just ask Chevron. So it's just that there's that gamemanship that has to, and this is why I love geopolitics, because there's so much of that coming through it. And I think that when you look at the inflation side and you look at the game that they're playing, they're happy where crude is. Yes. And I think the way they get back at us is saying, oh, did you want $50 crude? I don't know what $50 crude looks like. Like, I know what $80 crude looks like, and I'm going to keep it there. And I think that is how they get back at us in terms of that inflationary side and making us feel pain because of what Gary and I have been talking about, raising those rates. And
gentlemen, Gary, you in 1 minute, can you give us some closing comments? This is phenomenal. This is great.
Yeah, I'll make it quick. Regarding the subject matter we've been talking about today, I'm fortunate enough to be able to talk to Mark about this, and he and I talk frequently just on the phone, just offline. We send each other messages on Twitter. But the New York Alternative Investment Roundtable has already provided me with an incredible person to discuss this with in Mark Rossano, and has provided the two of us with 2 hours of time to address you guys, to address your audience. I don't have anything more to add. Our views on this are well documented and I think clearly explained. I'm grateful to you, Bob, to BJ, to the New York Alternative Investment Roundtable for hosting me, for putting Mark and me in a position where we could get our views, time and date stamped ahead of the Bank of Japan throwing in the towel. Yes. That's fantastic. And my last point on this is the level of detail and due diligence, analysis, and expertise that Deep Knowledge Investing brings to the table. Fortunately, we've been able to welcome some members of the roundtable as paid subscribers for Deep Knowledge Investing.
Oh, that's outstanding. That's great news.
Thank you. So for any of you who are interested in that, just check out deepknowledgeinvesting.com. There's a subscribe now button, or shoot me an email at ir@deepknowledgeinvesting.com.